Hello, personal finance class. So, chapter 12, all about banking. We're on to sections 3 and 4. We're going to cover these today. So, the objectives that we're going to cover in this part of the chapter are by the end of the chapter, you'll be able to list and explain what are other bank services. And you'll be also able to explain the role of the federal government in banking. Again, I want you to be taking notes, actually writing this stuff down. It'll help you to refer back to answer questions at the end. So, what are some other services that banks provide? So, one thing that banks provide are called safety deposit boxes. Maybe you've seen these in movies or something, but it's basically a great big vault, and you go in, and there are boxes all along the wall. It looks like when you go to the post office, you have like a P.O. box. You have a little key, and you open it up and get your mail, a little slot. It's like that, but it's very heavily fortified with a huge bank vault, and you can put anything you want in there. You could put important documents. You can put cash, jewelry, valuables, anything like that. But banks offer safety deposit boxes as well. Another thing that they offer. Yep, and so safety deposit boxes are small containers that are located inside a bank vault to keep them safe. You can use them to store small items of high value, again, like jewelry or something like that, or legal documents that are important that say you wouldn't want destroyed in a fire or something like that. Another thing that banks provide are cashier's checks. So cashier's checks they're written just like a regular check that are your checking account, but instead of the check being a direction to remove the money from your account, the bank actually takes possession of that, and the bank makes it out from themselves. So they will take the money from your account, and then they will issue a check from themselves, from the bank. So the bank, again, will take the money from your account, and the reason that these things exist is because it offers increased security for people who are getting paid. So we talked a little bit about personal checks and checks bouncing. So if I were to write you, I could write you a check for anything. I could write you a check for $1 million. But you know what? There's not $1 million in my account. So when you go to cash it, it's going to bounce and you're not going to get your money. However, if I were to take that check and I would go to the bank and I would have to have the $1 million in it, I would make a check out for $1 million, and then the bank would say, okay, I'm going to write you a cashier's check. They take the money and then they issue the check from themselves. So as someone getting paid, you know that check is definitely going to clear because it is from the bank. Another thing are money orders. So money orders are the same as cashier's checks, but you can actually get them at the post office. So you can go to the post office and you can give them cash and they'll write a check that's from the post office. So it's really the same thing, but it's a banking service, but it's really provided by the U.S. Postal Service. Traveler's checks. So not many people use these anymore, but traveler's checks are actually payable by the bank or whatever institution that you get them from. But they're not made out to anybody. You're basically getting these blank checks that don't have a payee, and you can use them, say, if you go on vacation. That's what they're intended to do. People don't like traveling with a lot of cash on them. So if you get traveler's checks, it adds another layer of security for both the payer and the payee. So you've got these checks. So someone's going to have to cash them, and then there's going to be that paper trail like we talked about before. And also, if you're receiving that money, you're not accepting a personal check with the risk of it bouncing. You know that these are already basically prepaid, and they're going to clear. They're going to get cash no matter what. Bank draft. So an authorization to actually take money directly from your account. So that happens a lot of times when you set up, like when you have a bill you have to pay, you can go online and actually enter in, instead of writing a check, which has the numbers of your bank account on the bottom, and that's how the bank knows where to get the money. You can actually go online and type those numbers in, and then it creates a bank draft, and they will actually pull the money from your account. So banks allow that as well. Yeah, and these are usually for like repetitive things. So if you have, a monthly car loan, you could have it set up to do a bank draft, and they'll automatically take it from your account each month. So it's just one additional form of convenience. Instead of writing a check and mailing it every month, you can just set up a bank draft. All right, so some other online services. So most banks offer things like peer-to-peer money transfers. So a lot of you, I think, have used Venmo before. A lot of banks offer their own sort of version of Venmo. So that's another thing that banks do as well. They also offer online bill pay. I use this at my bank. I can actually go in, and instead of writing a physical check, I can just type in who the check should be made out to. And then the bank themselves actually creates a check and they mail it out. So it's a nice convenience. Instead of having to have stamps and having to have envelopes and print things out and send things in the mail, they'll actually do it all for you. And lots of banks offer a lot of online conveniences to view your balances and set up new accounts and transfer in between accounts. I do this all the time as well. Like I have a personal savings and a personal checking account. I go in and I move money around. I can check my balance and I can see through that online banking portal exactly whom I paid and how much I paid. I can check which checks have cleared and things like that. So it's a nice feature to have. All right, so moving on, the next section is all about deposit insurance. So maybe you haven't thought of it yet, but it used to take quite a bit of amount of trust to actually go to a bank and give them your money and know that it's going to be there. There used to be not something called deposit insurance, and I'll get to what it is exactly, but there would be, if a bank failed and you had an account at that bank, your money was gone. There was less regulation, and banks could fold if they made unsafe investments and they lost their money. Then they just lost your money, and your money is gone. So, deposit insurance was created to really insure your bank deposits, and of course, that came with a lot of regulation around what banks can do, because that insurance is actually granted by the U.S. government. So, there's a branch of the government, or a sort of a committee, if you will. It's the Federal Deposit Insurance Corporation. So this was created after the Great Depression. We're not going to watch that video. The Great Depression was a time in the 20s and 30s when really the banking system collapsed, and there was a huge issue with a lot of stocks that became basically worthless, and the banks that had invested in them lost all their money, so they lost all their clients' money. So people like you and I who put our money in the banks, they gambled it and they lost it, and it was gone. So people did not have the savings that they put into the banks. So the FDIC was created. So what the FDIC does is they provide insurance on the first $250,000 at insured institutions. And basically, any retail bank is going to be insured. You basically can't be a retail bank without FDIC insurance. And this insures checking accounts, savings account, now accounts, CDs and IRAs. We haven't talked about those yet. Don't worry about it. But all the basic banking accounts you can open are covered by this insurance. So if the bank goes belly up, you're still going to get your money, or at least the first $250,000 of it. And you know what? If you've got over $250,000 in a checking account, you're doing something wrong anyways. And we'll get to why that is. But the FDIC guarantees federally it is insured. You will get your money no matter what. Even if the bank fails, you will get your money. It is insured. Similar to the FDIC, the NCUSIF, or NCUSIF. So that stands for the National Credit Union Savings Insurance Fund. So it's the same thing as the FDIC, but only it insures credit unions instead of retail banks, because credit unions are considered to be non-profit. So same thing, different organization that provides the insurance. All right, so the Fed. The Federal Reserve and the banking system. The Fed is very important in our banking system. So what the Fed is, you'll hear that on, if you watch, any sort of show about money, or the news, you'll often hear that the Fed is raising rates or lowering rates. The Fed is basically a bank for banks. When banks need money, they go to the Fed. What are they responsible for? So they're responsible for regulating the banks. So by regulating banks, they are required to say, we won't, I'm not going to require that you guys know this kind of stuff, but banks, for example, are required to keep a certain amount of deposits on hand. It's actually pretty low. So all the cash, if everybody brings in a deposit in one day and they have $1 million worth of deposits, they're really only required to keep about $50,000 to $100,000 of that on hand in case people come in and want their money out. They can take the rest and they can invest it or move it elsewhere. They have to keep usually only between 5 and 10% of that money on hand. And it could actually be lower. It changes, and the Fed sets that. The Fed is also responsible for implementing monetary policy. So don't expect you to know what that means. But the Fed, they're interested in keeping things stable. So they are going to use interest rates and all the things at their disposal to make sure that happens. So they require that banks do other things as well. What they're interested in keeping at all times, the Fed, they want to keep stable prices. So they don't want inflation. Inflation is when the prices of goods go up drastically. So you say you pay, $20 for something today, and then tomorrow it's the same thing costs $30. That's inflation. The Fed is really responsible for and is interested in keeping prices stable. They don't want high inflation. They want to keep maximum employment. They want as many people working as possible, as many people making money and contributing to society and in the workforce as much as possible. Those are two major things that the Fed wants. So how do they do that? How are they able to do that? So one way, I just talked about the reserve requirement. They can require that banks hold more money. So that's one way that they can actually slow down money in the system, is by making banks hold on to more of it. When they don't have to hold on to as much, that means they can invest more, and then they can loan more. So when that happens, that means more money is going around, more is being spent, more people have more money to do more things. When banks have to keep it tighter and have more of that money on hand, that means less people have access to that money, and there'll be less money changing hands. And in general, it will stifle the economy a little bit. It will make growth a bit slower. They have full control over what's called the discount rate, which is the rate at which loans are made to banks. Another thing that banks actually do is they borrow money from the Fed, and they take that at a very low interest rate, which is, I don't even know what it is, to be honest. It's got to be, it's probably still around 1%, maybe even less. So they borrow at 1% from the federal government, and then they loan it out at higher rates, right? Or they take that and invest it. And of course, it's regulated. There's only certain things they can do with that money. And they have to prove what they're doing with it at all times. Ton of regulation in banking. But the federal government maintains that discount rate. So the rate at which they loan money to other banks. So if they decide to raise that rate, that means banks have to raise their rates. And in general, that can stifle the economy too. So, and the opposite's also true. When they lower that rate, that means that banks can offer things at lower rates as well. And that tends to accelerate the economy. And people borrow more when rates are lower, and they spend more. And the third is called open market operations. So I'm not going to get into in detail what this actually is, but basically it means they're printing money. I mean, the federal government owns the printing presses. They own the mints at which, coins and all paper money are actually printed and pressed and made. So they can print more money, and then they can buy government bonds on the open market. So that's another way they can do that. Don't worry about what it means so much. It's kind of complex. Feel free to look it up and learn more about it if you'd like. But I'm going to leave it at that. So they basically print money and they buy their own bonds, and that's a way that they can also accelerate the government, or sorry, accelerate the economy. All right, so let's review what we've talked about. So, what are some of the other bank services that we talked about? I'll tell you what, just describe 3 of them. What are 3 of the other bank services that we talked about? Other things that bank do, other than just, taking deposits and making loans. What are 3 other things that we talked about? And second of all, what role does the federal government have in banking? What are the 2 major things that it is interested in doing and maintaining, and how does it do that? So explain that for me. All right, guys, a little bit quick this time too, as we are wrapping up this chapter and wrapping up the year. So if you have questions, let me know. Thank you.